Good evening, ladies and gentlemen. A warm welcome to one and all to Intrazon, India's largest retail intraday traders online conference. Well, friends, today is the first day of the event. This is Ashok Devanampriya, your host, and also the founder of Traders Gurukul. It's great pleasure and honor to have all of you guys today in this beautiful session. So, our first speaker of Intrazon is Mrs. Swapnajasharma, a good friend of mine, professional trader, founder of Words Unlimited. She's a passive investor and she's also a very good trainer. She has trained more than 500 people till now. She has her own YouTube channel with her own name. She has been in the markets for close to 12 years now. I'm really honored to have you, Swapraja, in this session today as the first speaker. Thanks a lot for accepting our invitation and being with us to share your valuable knowledge to all our participants on RSI Divergence.
Thank you, Ashok, and thank you for this wonderful opportunity. So now I'll start, I guess.
Please, ma'am, go ahead.
So guys, I just want to know how many people know me. I just need to just emphasize on certain points, so I'll get an idea.
You are popular, probably people know you.
I just, can you just type yes, no? Okay, better you type no. I guess yes will be there. All right. Okay. Fine. There are people, couple of people. All right. Fine. We'll start with this. Now, this session is again RSI divergence and when and how to trade it. Okay. So, what is RSI? You guys know this is the very basic. I'm just going through these lines. The relative strength index is a popular momentum indicator used in technical analysis that measures the magnitude of recent price changes and evaluate overbought and oversold conditions. So the RSI is displayed as an oscillator which has 0 to 100. We all know all this stuff, right? And this guy actually developed this Mr. Wilder in 1978, and I owe him a big time. I mean, I really thank this guy for this particular beautiful indicator, basically, RSI. Now, as we all know, the traditional setting of RSI is 14. Okay, this is like by default setting of RSI is 14. Now, above 80, it is overbought, right? And below 20, it is oversold. So, when it is an overbought situation or condition, we actually don't buy. I mean, according to RSI, we shouldn't buy, right? And when it is an oversold condition, then according to traditional settings, we shouldn't sell. But I have certain my settings to RSI. Basically, I have tweaked, and these are my settings. I always use RSI 3 and not 14. Okay. Then when it is above 80, for me, it is a strong trend. So I always buy above 80 only. Okay. And when it is below 20, for me, it is a strong bearish trend. So I always sell below 20. But with this setting, you can do this. With this setting, you can't do this. Okay. So for this, you need to have RSI 3. And now again, many people ask me why ma'am RSI 3. Basically, it's just because I guess I always think that 14 is a bit lagging. Okay, but when you just change it to 3, you can get the opportunities on that particular spot when the trend is about to start. 14 is something it is lagging. You get the opportunity after some time when the trends already have started. So I always use this setting. Fine, but now this is we will talk about divergence, and you can spot the divergence using this particular 14 only. So that is not a problem at all. But this will we will need this setting when we'll trade the divergence. Okay, that I'll show you in later part. So let's begin. Now again, what is RSI divergence? Okay, RSI divergence means that the indicator does not agree with the price action. It's very in simple format, that indicator is saying something and price action is saying something. They are totally in opposite direction. So indicator is in opposite direction with the price. This is very basic. Now, do you guys know that how many types of divergence is there? We'll talk about time frame and everything later in the later part. We'll just first see what is divergence. So do you guys know how many type of divergence is there? Can you just type it out? Two types. Which two types? Bullish and bearish. Okay. Okay. Right. Right. Mr. Ganesh. Perfect. Regular and hidden. Of course, there is bullish and bearish, positive and negative, plus minus. Okay. All right. Fine. We'll see. There are basically two types of divergence. Okay. The first is classic divergence. Okay. This is very, this is very well-known divergence. Many people know about this divergence. But the second, which is hidden divergence, and not many traders actually know about this particular divergence. But according to me, this is more powerful divergence than this classic divergence, and we'll see how and what. So we have like two type of divergence. One is classic, and second is hidden. Now again, in classic divergence, we will find the classic bullish divergence and classic bearish divergence. And in hidden divergence, you will find hidden bullish divergence and hidden bearish divergence. So this is bullish and bearish a part of this both divergence, but mainly the divergence are of two types, classic and hidden. Okay. So we'll see now what is classic divergence. So first we'll see what is classic bullish divergence. Now this is the price, okay? This price is coming down and this is the RSI. Now what is happening? See, price here is making lower low, right? These are the swing lows, right? These are all swing lows. But here price is making lower lows. But what about RSI? RSI is making higher highs. So here price is coming down, but here RSI is going up. And so this is what is a bullish divergence. So what actually RSI is indicating here, RSI is indicating that now price might go up. There are chances now that the price will go up from this particular point. Okay, so this is the view. This is how we form the view of the market. Okay, now this is not like you have spotted the divergence and you will start trading it right away. No, there are certain rules to it, how to trade it. So that we'll again see on a later part. First, we'll understand what is divergence. So when it forms in bearish market conditions and can be used as trend reversal strategy. So this is a trend reversal strategy, and when it forms in bearish market conditions. Fine. And now this is the example of basically HDFC Bank 15-minute time frame is this, and you can see this is lower lows of the HDFC Bank, and RSI is giving you higher lows, and then you can see the trend. So this is what this is classic bullish divergence, which forms in bearish market conditions and used as trend reversal strategy. Okay. Now we'll see what is classic bearish divergence. So now again, this is the price which is going up, and this is RSI. Now if you can notice here, what is happening is here is price is making higher highs. Okay, these all are swing highs, and this price is making higher highs. But at the same time, this RSI is making lower highs. So now what it is indicating? It is indicating that now price can come down from this particular point. Again, this is the view. So when it gets formed, it forms in bullish market conditions and can be again used as trend reversal strategy. So if the trend is up and you will see this higher highs, but the RSI is making lower highs, it means that trend now can get changed and the price will come down. Okay. Now again, this is the example of Reliance Industries. Here you can see this is the higher high which Reliance have made, but at the same time in RSI, this is the lower heights. See, and then Reliance fell down. So this is trend reversal. This is the bullish trend. Now after this particular divergence, trend got reversed. So this is the trend reversal strategy. So classic divergence is known for trend reversal strategies. Okay. Now we'll see what is hidden divergence. Now this is very important. What RSI to use here for divergence? You can use 14, which is traditional. You can see, you can spot divergence with 14 also, but I basically use always RSI 3. Okay, so whatever examples I am going to show you is with RSI 3. So this is, we'll see now what is hidden divergence. Now first we'll see hidden bullish divergence. Now see what is happening with the price here. Price is going up and what RSI is doing? Have you spotted this? What is happening here is price is making higher lows. Okay, price is making higher lows, but at the same time RSI is making lower lows. These are the swing highs and these are the swing lows, right? And what is happening? Price is making higher lows, but RSI is making lower lows. So what actually, when we use this particular hidden divergence, it forms in bullish market condition and can be used as trend continuous strategy. Now what we've seen right now with the classic divergence, that is a trend reversal strategy, but this is trend continuous strategy. So if you know that certain particular script is in a bullish trend, and you know any script, any stock which goes up, it goes like this, it goes up, it just retraces it back, then it goes up, it retraces back, and then it goes up. But if you want to ride this trend at that particular time, you should wait for the hidden divergence. So at this exact point, you will know that now this is going to move forward again. So this is trend continuous strategy, and if you want to participate in a trending stock at that particular time, you can use this particular hidden divergence strategy. And we'll see examples here. Now this is Bank Nifty 15-minute chart. This is actually yesterday's chart. Okay. Now see this. This is one swing low and this is the second swing low. These are higher lows. Okay. But what RSI is doing? RSI is forming lower lows. It means that after this, it is going to continue its trend. We all know that since many days, Bank Nifty is in uptrend, right? So this was the perfect time to get into the Bank Nifty trade. This is yesterday's chart. These are higher lows and these are lower lows. So this is the main trend which Bank Nifty is following, which is bullish trend. And if you want to enter it in this trend, so this is the time you can enter it here again and ride this trend. So this is hidden divergence, hidden bullish divergence. Okay. Now we'll see what is hidden bearish divergence. Now what happened is hidden bearish divergence. See, this price is going down. It means the trend is bearish, right? And at the same time, what RSI is doing, RSI is forming higher highs. See, what price is forming? This particular price is forming lower highs, right? In bearish condition, it is forming lower highs. But what RSI is doing? RSI is forming higher highs. And what is the trend? Trend is bearish. The price is coming down, right? So when it forms in bearish market conditions. And it can be again used as trend continuous strategy. So classic divergence, we use it for trend reversal strategy, and hidden divergence, we use it as a trend continuous strategy. Now again, this is the example of it. Now this is the looping chart. You can see this is two lower highs. Okay, looping is in downtrend. It is falling. It is falling and it is retracing it back. Now it has made one swing high here, but this is lower high. At the same time, what happened? RSI is forming higher high. Okay, and after that, further you can see looping fell down badly. So these are mainly two kind of divergence. Okay, so I just want to know, have you guys understood up till now, or you want me to again repeat it? Just type something. Whatever examples I'm showing you is of RSI 3. Okay. Understood? Together understood, nice explanation. Time period will talk. See, I'm just actually making you understand what is divergence, and these are two divergence, and when we use this divergence, this is the main thing. Yes, we will see more chart examples. We'll actually see on live examples too. So that's okay. I'm just doing this for the theory purpose. Can you repeat classic? Okay, I'll repeat classic. How will we differences between classic and hidden? What is the difference in classic and hidden? Theoretically understood. See, when classic divergence forms, you know that whenever price is falling down, right? And after certain time, it actually reverses. So we can spot this. I'll again repeat those slides. Okay, so people who don't understand it, we'll just repeat it from here. All right, we'll again do this part. Classic divergence. Now, when this classic divergence form, the price is falling, right? And what RSI is doing, price is forming lower lows. These are lows, right? When the stock is falling, it forms always lower lows. But at that particular point, RSI is forming higher lows. See, and this is the time we should understand that now price can be reversed, the stock can be reversed, the trend can change. Okay, there is a possibility that trade can change. So always in bearish market conditions, we will watch for this particular divergence. Okay, in bearish market conditions. And this can be used as trend reversal strategy. This is the again example HDFC Bank. This is lower low, but the RSI is forming higher low. And I'll actually show you some examples on a particular trading view, so you'll understand it more. I'm just repeating this. Classic divergence. This is bearish divergence. In this, price is going up, but at the same time, what RSI is doing, price is actually forming higher highs, but RSI is forming lower lows. Sorry, lower highs. So it means the trend can change. So it forms in bullish market conditions, and this is the trend reversal strategy. So in this example, you can see that Reliance was in uptrend like this, but here it formed the higher highs, but RSI is clearly showing lower highs. So this is the chance that Reliance now can fall. The trend of this particular chart, which is Reliance here, it can fall. It will change and it will fall, and it fell. Right? So classic is used for trend reversal, whereas hidden divergence is used for trend continuous. Now see, hidden divergence, suppose any script is in uptrend and now you know that it is